All right, folks, we are back. It is officially time for the Federal Reserve to speak, particularly Jerome Powell to speak. Everyone's eyes and ears that cares at all about business, stocks, and finance are going to be listening to Mr. Jerome Powell and what he has to say over the course of the next hour. 2:30, so we got about 7 minutes until this starts. What did the Fed do for those that are just joining? Thank you, everybody, for being here today. We will transition this entire stream into the market close after Jay Powell is done speaking. The Fed, what did the Fed do? The Fed paused. The Fed paused once again. And, I just feel like we all need to be a little bit more surprised at what the Fed's doing. I mean, I'm seeing everyone on Twitter basically saying, oh, we all knew the Fed was going to do this. It's not that big of a deal. Like, why is it so shocking? It's shocking because the journey is what matters. It's all a journey. Like, we will look back on this years from now, either in a horrible recession or in a raging bull market. And remember that on Wednesday, May 1st, or we're probably not going to remember because it's too specific, but on one of the Fed FOMC meetings, Jay Powell did what he had to do. It could be worse. He could have told us to all take a hike, literally. And he did not do that. He said, we're going to chill out. We're going to let this play and we're going to see what happens. And that's probably also what he's going to say in the next 10 minutes. And so I think we just need to remember that it's part of the journey. And look at Jerome looking very dasher, saying that we're going to keep rates the same. Now, the last time we raised rates was April of 2023. I'm going to pull up this chart I had real quick on Fed rate cut history. Let me pull that real quick. Here it is right here. So yeah, last time we raised rates was, it was July. So we've had the same raise. We have the same rates, 5.5 to 5.25 from July 2023, right? We haven't really raised rates in a while. Is it Dapper? Is Dasher not? It's not Dasher. I thought it was Dasher, dude. Oh my God. I thought it was Dasher, not Dapper. Okay. Yes. I said Jerome Powell's looking Dasher. I meant to say Dapper. He did not speak yet. He's going to speak in 4 minutes. I thought it was Dasher, dude. I really thought I pulled that one off. I was like, oh, he's Dasher. Why am I thinking of reindeer, dude? What the hell is going on? Anyway, last time we raised rates was in July 2023. So again, you can see we started back in March of 2022, 25 basis points. That's when rates were basically zero, right? We were coming out of the pandemic. And then for 1, 2, 3, 4 months in a row, or 4 meetings in a row, Jerome raised this thing 3 times each, 75 basis points each, right? So 3 hits of 25 every single meeting. This is when stocks did the worst. June inflation was at 10%. Bitcoin was around 15,000 around this time. Palantir got like $6-7, right? And then we slowed down and we paused for the past year. The reason we have not been able to cut is because inflation has not officially come down, at least not to what the Fed wants it to be in terms of their targets. And that's why inflation is still an issue. If we look at the 10-year right now, 4.63. So that's coming down just a little bit. Oil prices are still down on the day, which is nice. Look at oil, dude. Wow. We got oil below 80. Oh my, there you go. There you go. Oil. I didn't even see that. I did not see that for a while. Oil below 80. Not bad. I haven't looked at that since the market opened. Maybe the Fed's decision got the market thinking that it's time to have oil to come down a little bit. Is the market going up? Wow, market's actually going up a little bit. We're getting look at those green candles on the S&P. Google 165, Palantir 22.27, Robin at 16.87, SoFi 6.89, Pfizer having a great day, up 6%, 27, Neo up 12% on the day, incredible for Neo. Amazon 179. After their earnings, they should be even more in the green, but still they're green. Coinbase back to green, 213. CleanSpark eliminating some of their gains. Bitcoin, where's Bitcoin? I think it's at 58 or close to 58. Bitcoin 57,940, about $60 away from 58. So right before Jay Powell speaks, the market's starting to buy in. This could also be a lot of algorithmic traders coming in, and they're going to trade based on the words that Jay Powell says. And if Jay Powell says words that are relatively hawkish, which I don't think is going to happen, market might sell off. But if he sounds relatively dovish and hey, rate cuts are still on the table, maybe we do a little U-turn. Maybe the market turns out to be actually a bit more green. We got Adam in the chat saying, holy moly, finally some green. Yeah, I think Jay Powell's not going to be crazy. I think he has no incentive to spook the markets. Markets have already taken a bit of a tumble. We're still up fantastically for the year, especially in a lot of stocks. By the way, some stocks are having a horrible day, so it's not like J. Powell needs to get rid of the froth in the economy. AMD is down 8%. It was down 9% at one point. There's some green candles right there. SMCI is probably down 14%. SMCI is down 12.6%. It was down 16% about an hour and a half ago. DJT as well, taking a tumble. Wow. Trump was at up 5% today. Now it's down 7%. So it's not like the stock market is filled with froth, in my opinion. I mean, the companies have definitely taken a little bit of a beating, and the companies that have got momentum like Google is because they gave a dividend, right? They gave back to shareholders. Amazon, 17% year-over-year AWS growth. Insane. So I think companies that have executed have been rewarded, and J. Powell doesn't feel the need to get rid of a lot of the froth in the system because, quite frankly, I don't think there is a ton of froth in the system at the end of the day. But we'll see how this ends up playing out. So we've got J. Powell in about 1 minute. He'll be live. And what we see have there. Thank you everybody for being here. Appreciate you all today. Hood has a great leg up, correct? Robinhood, nice leg up this morning. Let's just see if J. Powell can continue to keep the momentum going. I'm going to pull up another version of the stream just in case this one's audio is not as good. So I'll have two, and then as soon as this starts, let me know if the audio sucks or not. And then we'll keep going. PayPal still red. Yeah, that's just, I don't know why PayPal's red. That's just dumb. That's really dumb. All right, here's JPL. CNBC doesn't always have the best audio, so if it sucks, we'll just switch real quick. But we'll see. Pfizer's up because they were down at a 10-year low and they beat on earnings, and they have a 7% dividend or 6.5. So at some point it was going to bounce. Today's bounce. Now the question is does Pfizer have? They got some approval from the FDA for some gene therapy vaccine, but you have to really believe that Pfizer has some long-term value to get in there. Or maybe you want to chase some yield, right, with the divvy. Oh, they missed on EPS? Well, they definitely beat on revenue. Did they miss on EPS? Did they? Pfizer. No, they beat on EPS, dude. They beat by 57%. What are you talking about? They beat by 57. Yeah, 82 cents versus 52 cents expected. What will it take to raise small caps? Inflation's got to come down, dude. Everyone, the whole Tom Lee thesis about IWM, I've just never been that excited about that thesis at all. And then the TNA, right, which is the leveraged fund on IWM, I think rate cuts have to happen, which means inflation has to come down for IWM to break out. And most of the companies in IWM are not profitable. So it's like IWM is not exciting. But we'll need inflation to come down. Powell will probably talk for 35 to 45 minutes. It depends on how many questions he gets. Oh, hold on. We got it. He's live. Wow, the CNBC had the wrong stream. Here we go.
Our dual mandate objectives. Inflation has eased substantially over the past year. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. And the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter, underlying demand was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also look at surveys of workers and surveys of workers and businesses and ask workers, are jobs plentiful? And ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
Expectations are not anchored.
or anchored, stable, roughly? Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well. And if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive.
He just said no hikes.
What would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time.
S&P is going up.
That's not what we think we're seeing, as I mentioned, but that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that. So it would be the totality of all the things we'd be looking at. It could be expectations. It could be a combination of things. But if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. if we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take, which would cause us to want to consider rate cuts. And those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%. And another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing. And also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
That's a good big
Yeah,
question.
I'm not really thinking of it that way.
He's not going to answer that shit.
What we've said is that we need to be more confident, and we've said, my colleagues and I today said that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Yo, he's trying not to answer.
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter. And I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path than a 2% inflation. That's the signal that we're taking.
Steve.
Yeah, Mr. Chair, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence, and that it's going to take longer to get that confidence. But confidence, I just think you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that. No, I mean the active tool of monetary policy is, of course, interest rates, and this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Torres from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth that's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree. It's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. We didn't get our confidence in that didn't increase in the first quarter. And in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them is further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation. And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%. And that won't be, so I don't see the stag or the inflation, actually.
I don't see the stag or the inflation. Let's go, baby. Let's go.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up. And of course, he's Mr. Potential Growth, our star. Do you share that view? And would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. I mean, the question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy. That's not about productivity. It was about having more labor, frankly, both through in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year for that matter too. So I think in that case, I think you really do have a significant increase in potential output, but you've also got more supply, but those people also come in, they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point, you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive. And, our evidence for that I went over earlier. You see it in the labor market, you see it in inflation sensitive spending, where demand has clearly come down a lot over the past few years. And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between, starting to cut in, say, September versus December?
Good question.
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. You know, it's hard enough to get the economics right here. These are difficult things. And if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And, you know, we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing. And we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And you know, we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think roughly. So yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You were Nancy. Sure.
It's going good.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes. I mean, I think that restrictive monetary policy is doing what it's supposed to do. But it's also, in this case, unusually working alongside and with the healing of the supply side. This that was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And so this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expected that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets, at least, have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So that you're right. I think that may happen. And you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy? Or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it had to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Hi.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious, gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question though. Thank you very much.
All right, folks. Powell pumped the markets. He did what he had to do. This is pretty much what most people expected Powell to do, and he followed through. And the reason he followed through is because it made no sense to go the opposite direction, and thankfully he didn't go in that direction. S&P 500 right now up about 1%. A little bit of a red candle there. We topped that at about 507. Right now at 506, as you can see, the red candle is getting a bit smaller. Palantir 2261 up almost 3% of the day. Google up almost 3%, 2.37. QQQ now green. They were red in the morning, up 1%. Amazon getting the earnings pump they deserve. 17% AWS growth. Operating income's the highest since 2021, 10.1 versus 8.4%. They deserve to be up, forget 5%, probably 7 to 8%. We'll see if it holds. But right now, Amazon getting some momentum as well. AMD, a little bit of the blow is being softened from what we're seeing, and we'll recap what the Fed said in a second, but we're just looking at some stocks. SMCI still down 11%. AMD was down like 9%. Now it's down 7%. Pfizer's up 7%. Neo's up 13%. NVIDIA, they were down 5%. Now they're down 1.5%, which is not too bad. Robinhood, nice green momentum. I think we topped out at 734. Right now we're at 1711 from 1640 on the day. So a little reversal there. SoFi up 5%, 707, which is good. Because stuck in the sixes made no sense. Dude, SoFi below 680, it was at like 660. It was just stupid. And so it's nice to see this. I don't know if it's going to hold. I don't know if any of this is going to hold, quite frankly. We're going to have to really see how the market interprets it tomorrow. But so far, seems like it's going to hold up. Coinbase is up 5%, CleanSpark up 0.43, and then Bitcoin as well started to get some momentum. So Bitcoin 58.2. Bitcoin was at 56 today. So about a $2,000 reversal here on Bitcoin, which is getting some of the Bitcoin proxy stocks excited. I think Bitcoin gets back to 60K relatively quickly. We'll see if that happens over the coming week, but I think that's possible. PayPal right here, 67.29. PayPal still red on the day, but overall markets are green, and J Powell did what he had to do. Now, what did J Powell say? Let's talk about that. What did J Powell say? We did cover Pfizer. We covered Pfizer in the morning. Pfizer's up again, 11-year low. They beat the EPS, beat revenue, and that's why they're up right now. And so that's why Pfizer's doing well. As Jet says right here, taking profits. I do think some people right now in the market are taking profits. That's why we're seeing a little bit of a dump. It's not a dump to the point where the S&P is going below 500, which this morning it basically looked like we were going to go below 500. Right now we're maintaining that 505 level. So what did J Powell say? From my understanding, and everyone heard the call at the same time, the tone I got from J Powell was pretty damn dovish. Even though he didn't say the things that the ultra bulls thought he would say. So the main questions that people asked, and I feel like these analysts had puts on the market or something because they had so many questions that wanted him to say that inflation is very bad and we're not going to be able to solve the problem. He kept saying the opposite. He was dodging those analyst questions like they were landmines, basically saying, no, inflation hasn't been solved over the past 5 months in 2024. However, we need more data. As we get more data, we still believe 2% is possible. That data will influence our future decisions. And then the big thing he said about 5 minutes into the conference, or 5 minutes into like the first Q&A, was that we don't expect another rate cut. And that was very interesting. That was very interesting because some people, particularly Bank of America, was putting out these client notes that says, Jay Powell's definitely going to pause this time, but after he pauses, the committee's likely going to think of rate hikes, right? And he basically put that to bed. He was like, nope, that's not happening. So he said it is unlikely our next move will be a hike. And this is a big deal because as soon as he says that, the market, they can handle up, they can handle down, but they cannot handle the volatility of uncertainty. And what Jay Powell basically is telling them, barring any really bad economic data, is that it is unlikely we will hike. So for all the ultra bears out there saying, oh, the Fed's going to have to hike, this is getting too bad. No, that's not what Jay Powell's thinking. No, we're not going to have to do that. And that was really important. So that was, I think, one of the biggest things he said. Then on stagflation, I mean, this was the goated moment of the stream. He says, I don't see the stag or the flation. I want to hear him say that again. We're going to go back to that clip and see how he says it in real time. But so from that perspective, Jay Powell doesn't think that stagflation is going to be a concern. He thinks inflation is coming down, which is where you don't get the inflation part. And then he thinks stag is not going to be stagnant, right? He thinks that we are growing. One of the reasons he said that the United States, it has an easier time of cutting rates than countries across the world that also are experiencing high inflation is because the United States is growing. Now, I know the GDP estimates a couple of days ago came in at 1.6% versus 3.4. And so, this is where this whole stagflation narrative started to come out of nowhere. But if we keep growing and those estimates get revised and Q1 earnings, end up going really well, we got Apple on Thursday, Q2 will be in the next couple months, then we will keep growing. And if we do keep growing, the stagnant part won't be there. If inflation comes down, the deflation part won't be there. And then Jay Powell will be looked at as a goat for saying I don't see the stag or the deflation. Or if stagflation becomes a thing, this will become an inflation transitory moment. And I don't think it's going to end up becoming one of those moments because I do believe inflation is coming down, which is going to be really good for Jay Powell. So, I mean, let's see how this all plays out. But as of now, this was a hell of a meeting. This was exactly what we needed to hear. He didn't sound overly hawkish. He didn't need to sound hawkish. And he pretty much fulfilled the market's desire, which is like not being a hawk when you didn't need to be a hawk, which is what I think the market really cared about. My SPY calls printed. Amazing. I love that. Very cool for you, Ryan. Star Buccaneer says, crazy how much the market focuses on Jay Powell so much lately. Yeah, Jay Powell shouldn't be the biggest focus of the market, but the problem is inflation being at this level means that there's only one guy who can really cut rates, which is Jay Powell and the Fed. And so what he thinks, his perspectives, his ideas, his ideologies, his sort of vernacular in terms of how he believes inflation is going, S&P right now heading up about 1%. That matters a lot, and it's mattered more than it's ever mattered since the 1980s because inflation has been a rampant issue because we printed $7 trillion. And that's not Jay Powell's fault, by the way. That's just not his fault. We printed $7 trillion, and we printed $7 trillion because we needed to print. Well, I don't think we needed to, but like the governments, Trump and Biden, thought that we needed to. And then Jay Powell was left with like all this money. Now, granted, could he have started hiking early? Yes. And he made a mistake. But I mean, if you were the Fed chair, like, could you blame the guy, right? Like, could you really blame if you're the 15% unemployment? You don't want to be the first to raise rates because you think there's a little bit of inflation. It turned out to be a lot of inflation, but nonetheless, I think he's doing the right job to try to get this resolved. Let's go to CNBC. Let's see what the suits are saying, how they're thinking of what Jay Powell said, and hopefully things moving in the right direction. So let's start from here. And keep going from there. Oil also below $80 a barrel. Incredible today. That's also really good for inflation.
At least when it comes to rate cuts, I want to note going in that Goldman is still sticking to its view of 2 cuts because they say the 2 pillars of disinflation are intact, those being lagging housing data and the fact that we don't have any more supply shocks. I'm curious as to what your take is now. When do we get the first cut and how many will we get this year?
It seems unlikely that we're going to get 3. That was in the Fed's dot plot back in March. I actually, based on what we're seeing in the inflation market and commodity prices, which have been weak recently, but they're pretty much at their 200-day moving average. Oil is up. I kind of feel that the base case now is 1 rate hike for this year.
Cut.
And I
You mean
certainly
cut.
don't think it's.
You mean
Oh,
cut.
sorry. Yeah, cut. Yeah.
Freudian. It's a Freudian slip.
got it backwards. But I don't think it's coming in June. I just don't see how that could possibly happen. There's just not enough data, and he certainly respects the fact that, I mean, lack of progress on inflation. That was not unanticipated that he would say that, because you can't disrespect the data. I mean, it is what it is. But I thought one interesting takeaway that I got was he mentioned that a couple tenths in the unemployment rate would not be a catalyst for easing. I've had the feeling that he needs the unemployment rate to get up to 4, maybe 4.2 even. And so we'll see what happens there. The unemployment rate has been up a little bit, but clearly it's not to the point where the inflation fight is less important than as the dual mandate, because the jobs part is behaving quite well, and the inflation rate clearly is the one that is lacking progress, as you put it. So I'm going to lean on one rate cut this year. I certainly don't think 3 seems very likely at all. So that's where it is. I think that higher for longer seems like the mantra continues, but without a rate hike. So this is a pretty good environment. The type of strategy that we've been advocating and implementing seems like it's going to keep working. It's been working really well for the past 6 months. And that is, that you can get pretty good yields by investing in securities in the fixed income market that aren't that risky. I'm not talking about triple C junk bonds or even single B junk bonds. I'm talking about things like single A, triple B, maybe high double B, that are priced off of the short end of the curve, or say off the 2-year or the 3-year part of the curve, where you can get yields that are in the mid 7s without a lot of risk. And that seems like it's going to be a very comfortable place to invest without a lot of volatility. And so you want to take advantage of this inverted curve, which has been inverted for a very long time now. It's one of the longest inversions in the history of the bond market in modern times.
10-year right now. Let's take a look at the 10-year. And then we got 30 minutes till the market closes. So 10-year, 4.624. Let's give a call to Steve. He had some interesting opinions. I don't know if he'll be able to pick up right now. But Steve's been texting me saying he actually doesn't like how Jay Powell's talking. So let's see if he picks up. But 10-year right here at 4.62, not too bad. It's down just a little bit, about 1.28% down. Yeah, Steve can't pick up, but down at 4.62%. However, again, we are seeing that equities are heading a bit higher, and equities are heading a bit higher based off the assumption that if rate cuts are coming, then maybe we shouldn't be that scared. Money market funds currently, we're going to get an update in a couple of days, but right now we have 5.98 trillion. Last week we added, did we add or we decreased? We increased by 9.313 billion. So this week's going to be interesting because this is the first week, real week after taxes. It decreased by 112 billion 2 weeks ago because taxes were due. Now 9.3 billion added to 5.98 trillion. Let's see if any of that decreases a little bit based on this idea that a hike's not going to happen, and maybe some of the money in the money markets want to chase some yield. SoFi right now 705s, Robinhood 17. Again, the pump. I don't know how long the pump is going to last. The point is we did get a pump, which is exciting. But the idea that, we're just going to go straight to the moon, probably not going to happen in a straight line. But the good thing is we're not going to get a hike in the next meeting, or at least we don't think we're going to get a hike. Now, if the next CPI cannot go well, meaning we do not make any progress on core PCE or headline CPI, we're going to be in a tough situation. We're going to be in a very, very tough situation. Bitcoin right now, 57,000. Okay, Bitcoin falling a little bit from 59. Wow, to 57. Nice little red candle right there. A string of red candles. Again, choppy market. Not going to be easy for the market to recover after what we've seen in the data. But Jay Powell said what he needed to say, and he didn't say anything that was aggressive enough to get the market, upset. And I think that's the core point that we wanted to see. We do have some Tesla news, so let's transition into some of the other stuff that's going on in the market. Obviously, Starbucks is big news for today. Starbucks still can't get any momentum, even with the J. Powell pump. But let's talk about Tesla. There was a Reuters article today around Tesla canceling certain things and Elon firing the supercharger team. So let's just get an update on Tesla, and we'll talk about some other equities as we get into the market close and keep going from there. Here we go. Here's some Tesla news.
Bring in former Ford hand in the auto market and what's next for Tesla. Let's bring in former Ford CEO and CNBC contributor Mark Fields. Mark, it's good to have you. We got a flash head right now from, I think, Bloomberg saying that Tesla retreats from next-gen gigacasting manufacturing process, according to sources. What are investors supposed to make of some of these headlines?
Well, I think if you're inside Tesla right now, there's probably a lot of confusion. If you're an investor, you're looking at the business right now and you're saying, listen, the last quarter, it burned cash. At the same time, you got lots of management turmoil. You got market share going down. You have more inventory than you ever held. And you're having all these kind of announcements that come out a bit haphazardly of what they're doing with costs, et cetera. So it's got to give them pause in terms of, their investment, what the strategy is for Tesla going forward. But also, Carl, if you're inside Tesla as an employee, you've got to be looking over your shoulder, because when you do these kind of reductions in workforce, usually what you want to do is you want to say, here's the percent we're cutting. Here's the date by which we'll be done with this, at least for now. And Tesla has not kind of articulated that. So it's a little bit of a drip by drip. And what you'll see inside Tesla's organization probably is a lot of paralysis right now.
Do you believe that less commitment to the charging network hastens a broader slowdown in EVs, like lowers the adoption curve even more?
Well, from a consumer standpoint, it's not a positive news, right? Because if you're a current Tesla customer, when Musk says, listen, we're going to increase the uptime of our locations, that translates into the customer saying, I'm going to have to wait more. I'm going to have more cars in front of me because he wants 100% uptime. If you're a customer considering a Tesla, you're saying, well, okay, it might be more inconvenient for me to charge this vehicle. And importantly, if you're a customer of any of the other OEMs that have signed up to use the Tesla network, it's a net negative in terms of from a consumer standpoint. So it doesn't help. But overall, over time, the adoption of EVs will increase over time, but it's going to be slower than everybody expected. And that's why you're seeing all these announcements of pushbacks of product and facilities. But this latest announcement, overall, Carl, it's a net negative.
Putting all the announcement in context and talking about the sort of cultural issue that you see over there at Tesla, Mark, is it an opportunity for some of the competitors like GM and Ford that have been trying to catch up on EVs, or is it more bad news for them too?
Well, Sarah, it's a great question. Like I said, from an overall market standpoint, it just basically says, listen, from a consumer standpoint, we'll wait until you guys all figure this out before we consider an EV. But if you're a GM, a Ford, or one of the other automakers, there is opportunity right now, because at least if you piece together the announcements that Tesla has made or has leaked around their product plans, it just sounds like there's a lot of confusion there right now. And, what Carl mentioned about the gigacasting pushed back, you recall from, Tesla's investor day a year ago, they said that was absolutely crucial to bring down the cost of their vehicles and also bringing out this sub $25,000 vehicle. So, if you're one of the other automakers, you're saying this is an opportunity for us to catch up as you see the turmoil in Tesla.
I don't really know if it's turmoil per se. I mean, I think they're doing a cost-cutting campaign that's going to allow them to get back to the burn that's not as aggressive as they, wanted to see. Again, they're burning $2.5 billion every quarter, but I do think that at the end of the day, we all know the story here is FSD, and if FSD works, then a lot of these internal idiosyncratic ideas, like cutting team members, layoffs, et cetera, are not going to be that important. Tesla down right now. NVIDIA going back down about 3%. The rest of the Max 7 being green, which is good. Overall market taking a little bit of a tumble. S&P still green, but holding on for dear life. It was at 507, now at 504. Palantir was at 2260, now 2240. Robinhood back below 17, 1690. SoFi back below 7. It's going to take a bit of a catalyst to get this market to go higher. I wouldn't say the market's dumping. Market dumping would be SoFi at like 660, right? Market dumping would be Palantir below 22. I would say the market's selling off. People are taking profits. But I definitely wouldn't say the market's dumping right now. The news was good. Jay Powell's presser was good for those that are just joining. The question is, can we maintain the pump? And look, quite frankly, it's going to take a lot more than Jay Powell being slightly dovish after the rally we've had over the past 90 days to not go down even further, right? To continue to sustain the pump. What it's gonna take is a rate cut or really good inflation data that basically signals to everybody the rate cut is coming. And we don't have any of those yet. But we do have someone who's willing to give us the rate cut, which is Jay Powell, not screwing things up today. Now, we do have Q1 earnings, which have been phenomenal. I mean, you can't be that mad if you're a Tesla bull. You went from 138 to 182, right? Google, you went from 150 to 165. Palantir, I mean, you went from 16 to 23, right, over the past coming months. Even NEO's up 12% of the day. So you really can't be mad at your equities. Amazon should be up a little bit more. You could be mad if you're if in Amazon. That quarter deserved like a nice 10% pump. But still, equities might have to take a little bit of a breather. S&P now 503. Let's see if it can actually hold the green it got today or if it just sells off aggressively right now. Jet says it'll pump tomorrow. Need to look at futures to see what happens then. Yep, I agree. Let's get some coverage on Bloomberg and see how they're thinking about what Powell said today.
Making, they're going to be that much more adamant about being.
I'm waiting for him to address that story that came out from the Journal in the last week. Still anonymous sources around the president talking about these issues. These are big issues.
Don't you feel like people are kind of like spitballing out there and seeing how the people react to it before they really kind of put any emphasis behind it?
Jeff Rosenberg's got things to say about this. Joins us now from BlackRock. He really doesn't. Stick with us, Jeff. I'm not going there. Don't worry. Jeff, it's great to catch up with you as always, sir. After what you just heard, does it make you incrementally more bullish in any way, shape or form?
Well, let's just say that going into this meeting, there was a lot of bearishness and fear that he would come out more hawkish. If you even look at, Bloomberg Economics put out their kind of preview, it was overwhelmingly expecting a very hawkish message. So I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman. He's been very much on the other side, has been one-sided, looking at the glass half full and reiterating, kind of the key point around an asymmetric response function. If inflation is higher, and it has been higher over the last 3 months, okay, we won't cut as soon as we were anticipating. But the questions and people who tried to pigeonhole them on, are you going to hike? Did you talk about hikes? Just deflected all of that. And that was a relief. So the reiteration on the asymmetry, as a result of the reiteration on they believe that policy is sufficiently restrictive. Those are two key things here that keeps a more dovish orientation in the face of some challenging economic data.
Jeff Rosenberg, on Planet BlackRock, is the economy doing okay? Is the real misestimation here a 1.6% GDP, which made a lot of news, but domestic final sales were much, much better. Is it better out there than we actually think? And that's why we heard a dovish Powell today?
Well, I think you have a mixture there, and you've heard it, as part of the exchange during the Q&A. In the aggregate data, yes, 1.6 understates it because, as you rightly point out, if we look at domestic demand, it's running at a stronger level. So the economy in aggregate terms is stronger. But what Bob Michel talked about in the earlier, or Michael, I'm not sure which way you pronounce it, talk about is, there are pockets.
Was that some BlackRock shade?
Yes.
Is that what that was?
That was 100%
Over at JP Morgan. I can confirm it's Michael. Carry on, Jeff.
Thank you. So there are pockets of hurt going on here, but there are also pockets of strength. So you have a distributional aspect in terms of what's going on in terms of the economic growth side, but clearly the amount of slowing, it was a question in the Q&A, didn't you need to have more pain to get the disinflation? Good news is we're still on the path of the immaculate disinflation, and the growth side is holding up. So I think that's quite supportive here to the risky asset perspective.
It seems like this is more supportive to the risky assets than it is to government bonds, right? I mean, this basically raises the specter of taking.
All right, we'll go back to that market again. I wouldn't say it's dumping. I'd say it's selling off. S&P is, if the S&P goes red, I'll say it's dumping, but we're not dumping yet. I'm holding on to it's a sell-off, not a dump-off. SoFi is below 7. See, SoFi's still up 3% though, so it could be worse. SoFi could be at 660. It could be worse. S&P has about 90 cents to go before we've dumped. For those that don't get the sell-off, again, J Powell being less hawkish is not a reason for this thing to pump to the moon. It's a nice reason to be green. It's not a reason to get back to all-time highs on the S&P, right? So I think from that perspective, it's not the most shocking thing to see a little bit of more of a sell-off. Palantir earnings. I actually have a video coming out at 6 p.m. today about my expectations for Palantir earnings. So that video will be out, and you guys will be able to hear all my thoughts on what numbers I think we're going to get for Q1. And we'll talk more about that tomorrow. But in general, Palantir earnings will be good. The problem with Palantir earnings, guys, is that if they blow the numbers out the water, but this macro does not get better, which we have, 10 days for that to happen? Like, Palantir is going to be flat, right? If anything, it could go down. I think it'll surge to about 25, 26 on really good numbers. But I don't know, right? Because if the macro is in a bad situation, Palantir is interest rate sensitive, even though they don't have any debt. Like, they're still susceptible to all of this. And so if they don't increase the revenue guidance, I think that's also, given this macro, not going to make the street very excited. If they do, which I think there's a chance they do, I think it can go very well. But this macro is not going to be nice to Robinhood, Palantir, any of these guys if things don't necessarily clear up a bit. Let's see what earnings we have after hours. S&P is at 502. Earnings after the bell. We're just going to go through them. We're not going to listen to any calls because there's not really any good calls to listen to. But DoorDash, that'll be an interesting one. Etsy. Zillow is going to be, that's a good one. About housing. That'll be interesting to see what they have to say about housing. Enovix and Qualcomm. Let's actually make our list right now. Let's make our list. So this is May 1 earnings. So we have Dash. We have Qualcomm. We have Enovix. And then what else do we have? We have, let me know if I'm missing any. We have Zillow, MGM, Carvana. That's a good one. Zillow, MGM, Carvana. Zillow, MGM, Carvana. All right, so we'll be looking at all of those after hours, and then Etsy. Etsy's a big one. Etsy as well. But that's what we got going on right now. That's what we have going on right now. HYLN is up 23% today. HYLN, what is this stock? I feel like I know. I've heard this ticker. HYLN. Hillian Holdings Corporation. Why have I heard this name before, dude? I feel like I've definitely heard this name. I don't know why it's up 20%. Market cap 271 million. Maybe they had some news come out. Where's SoundHound? We haven't looked at SoundHound in so long. SoundHound is up 5%. It's so funny. SoundHound's green, dude. Amazon can barely get up 5%. SoundHound, there you go. NVIDIA 839. NVIDIA selling off. SMCI also getting hit. Let's also discuss Starbucks a bit. Starbucks has just been an absolute disaster. Absolute disaster. Let me know if anyone has any stocks that we're looking at after hours when we ring the bell in about 15 minutes. Starbucks today, 74.18 down 16%. They are getting zero love. North American China sales are down, miss on an EPS and miss on a revenue. It's almost like the market kind of told themselves Starbucks is a dying company that's not going to be around for a while in regards to the drinks and coffee space, which I don't think that's the case. But if they are slowing down their growth, then yeah, I can understand how the market is upset, at least, about Starbucks and what we're getting from Starbucks. Here's the Starbucks CEO on the Q2 miss and what he has to say about what's happening and why he thinks it's bad. CVS also was bad. CVS was very bad. They missed EPS by 57%. So that was bad. Have you seen Root year to date? I have. Root, it's done very well. I think it's up like 8x year to date, which is amazing, but did not get into that one. All right, here's the Starbucks CEO. Let's see his explanation for what happened in Q2.
You look at the biggest loser today, it's going to be Starbucks. It's among the worst. First, we saw unexpected pressures on our occasional customers, more intense than we expected. That impacted their visitation. Second, the choppiness of the recovery in China continued with a more intense price war than what we expected. And third, challenges of our business in the Middle East that impacted us not just in the Middle East, but also in other geographies.
Okay.
Clearly,
I understand. Now, what I'm trying to figure out, sir, is why did you not feel the need to pre-announce this shortfall, given the fact in the previous quarter, your CFO said that she felt that you could have a earnings per share growth in the range of 15 to 20%. This is a substantial decline from that. And given the fact that you said on the call that April did not end well, I'd like to know why you did not feel the need to come out and say our quarter is going to be substantially worse than expected at least 4 weeks ago.
So basically, he's saying, why didn't you give preliminary guidance that our quarter is not going to be as good as what we originally guided for? It's a fair question. Snapchat did it a couple quarters ago. Let's see what he has to say to that.
I think, Jim, we've been working on action plans to address these headwinds. And so what we wanted to come back with was not just the announcement, but also the action plans that we have in place, which, by the way, are not business as usual. And I'm happy to talk about them.
Well, let's finish, because I know that investors are trying to figure out why they should.
I don't know what the hell he just said. I don't know if anyone can translate that. I do not think that answered the question at all.
Should hold on to the stock. Some of the things that I am confused about, I checked with all the major, both public and private companies that are in a similar business to you, and no one saw a 3% decline in comp stores because of weather, and none of them saw a negative number except for you. Is it possible that your coffee is just too darn expensive?
Good question.
Jim, I think that if I look at the U.S. occasional customer, they have clearly cut back on visits to us. If you look at the value for money scores we have, they're still strong, but there's no question that the occasional customer is cutting back on visits to us. We have not been able to communicate to them the value that we provide. So what we are doing about it is, it's not business as usual, but there's an action plan we have in place in order to do that, to reach them and to communicate the value that we are providing. What we're doing for that is we are making it attractive for them to come back into the Starbucks app and join it. On the app, what you will see is you will see value that they haven't seen because they've not been part of that environment. There are drops that are going to happen every Monday. There are bundles that we're putting in place that are attractive for them. For example, a beverage and a drink at a certain price. And so what you are seeing there is the effort we're making in order to ensure that our occasional customers get to see the value that we provide.
Why did the loyalty program go from 34.3 to 32.8 in linked quarter? I mean, those people are not occasional. Those people are hardcore. Why did your membership, and I know your membership was up 6% year over year. I'm not concerned with that. I'm concerned with linked quarter. Why you had not the occasional, but the hardcore drop off.
Jim, if you look at the most loyal customers, they actually continue to come in, they continue to buy us frequently, they continue to customize and upgrade. It's at the tail of the loyalty program, particularly those that are, in the 90-day active, as we call it. The folks that didn't come back, they again are very similar to the occasional customers. We have an action plan in place right now to communicate directly with them with offers that have gone out even as recent as this week in order to ensure that we can reverse the visitation losses that we have seen with them and to bring them back. And yes, you're right. Overall program did grow by 6%.
Right. That's necessary. But what's more important, I think, is the link.
I don't think he has the best answer to this question. I haven't seen this today, so I'm actually happy to kind of get an understanding of this. Starbucks is scary right now. The way the CEO is speaking about this quarter, not giving direct answers, kind of just hoping this interview gets over really quickly. And that's a good question. Jim said, to his credit, Jim's like, hey, your loyalty members went down quarter over quarter. These are not the average consumers. These are people that signed up. They left their accounts. Like, what the hell is going on here? Not a really good answer. Not from this interview.
Quarter decline. Now, let me, before I turn it over to my colleagues, you said it's not business as usual. And I want to make a point here, sir. You are still expanding as if it is business as usual. You had, for instance, on the quarter, you talk about opening stores in Honduras and Ecuador. Is it not time to pause, sir, and figure out what's really going wrong and spend a deep dive and making it so that this decline in comp store numbers does not continue? Because it is perilous to the actual existential existence of Starbucks.
Jim, thank you for the question. What I would tell you is, if you look across the world, our system sales in Latin America expanded double digits. Our sales in Japan expanded double digits. Our business outside of Malaysia and Indonesia in Asia Pacific showed growth. If you look at the US business and look at the fundamentals of the US business, we are holding share in the US. We are still the largest player in out-of-home coffee. If you look at some of the metrics that we
Dunkin'
have,
Donuts and Tim Hortons said you are not holding share, sir. I regard them as being seminal companies that are just as good when it comes to McDonald's says you are losing share. I can't go against those three companies. They are too good and too honest and too big for me to dismiss.
we are the leading category player in coffee. I'm talking visitation share and what we have. If you look at our in-home coffee business, it grew share 140 basis points. But if you look at the business underpinning us, tea grew 8%, cold grew 1%. So there are elements in here. If you look at our partner sentiment and what we have inside stores, attrition is down to its lowest levels. So there's work going in. The thing we didn't do enough of is really attack the occasional customer with delivering and communicating value to them in a more aggressive manner. That's what the plan we have does.
Luxman, it's David.
Dude, why don't they just lower the prices? Like, I mean, the shit's expensive. He's doing all this dancing when in reality, it's fucking expensive. Starbucks is, that's why I go to Dunkin' Donuts. I don't go to Starbucks. It's expensive. It is what it is. It's expensive. They got to lower the prices. They got to cut costs. Consumers will come back if there's cheap prices. I feel like that's because the experience at Starbucks is great. It's just, it's expensive. S&P is green. Market dumped. S&P is green. PayPal's green. AMD now down 9%. Palantir basically losing its gains. Google losing its gains. Robinhood maintaining a little bit of its gains, up 1.3%. SoFi up 2%. DJT down 9% today. It was up 5% in the morning. Tesla might go below 180. Markets red. Market is indeed red. Why is the market red? Honestly, if I'm being dead honest, dude, if I'm being dead honest, like literally graveyard dead honest, I think the market is red. Did I say green versus red? I'm sorry. Yo, this I'm sorry, I didn't mean to say. Yo, this is a mid-daltonic. I just Googled that word. That is the coolest word for colorblind. That is the coolest word. And look at this word, dude. This word specifically means you can't distinguish between red or green. I'm literally going to use this word forever. Daltonic, because I misspoke. Wow. Honestly, I think the reason the market's red is just because we're getting a sell-off, because Jay Powell was bullish, but not bullish enough, right? And that's normal. I think that's really normal. I don't think that's a big deal. I don't think that's bad. But it is what it is. Like, we can't expect the market to pump just because Jay Powell says we're not going to get a rate hike. I mean, we're not going to get a rate cut. So there's not anytime soon. But this word, daltonic, I love it, dude. I'm definitely going to use this word. This is amazing. But so yeah, that's why I think the market's down. Again, I don't think this is that big of a deal that the market's selling off. It doesn't seem like there's a structural problem. We pumped on Jay Powell not being afraid to say we're not going to get a cut or get a hike. So relatively flat. Jay Powell said he doesn't see stagflation as an issue. And now the market's selling off a little bit. If we get down to like 493, 496, then I'll be like, all right, so Jay Powell really did more damage, or he just didn't get the market to be convinced, which is fine. Maybe we need that. But going back down to where we started in the beginning of the day, it's like not that scary from what I'm seeing right now. Will says, LOL, nice one, bulls. My shorts are up 40%. Well, if you are short this market, you had a little bit of pain for like an hour, and now you're green again, even if you're short. My mother thought I was daltonic, but she was wrong. I'm just dumb. Oh my gosh, dude. It is the beauty of covering the global capital equity markets. We continue to get some red. Let's get back to Bloomberg. Let's just hear what they say for the next couple minutes, and then we'll end the bell, and then we have a ton of earnings to get into today.
Taking a rate hike off the table, which will benefit stocks of companies that have done really well with respect to earnings, but doesn't necessarily give that much of a boost to government bonds that are still subject to higher for longer. Is that kind of your view in terms of positioning on the heels of this, on the margin?
Yeah, and I think we have to segment between the front end of the curve and the back end of the curve. I think this is challenging for the long run in the back end of the curve, right? The Fed is from the most part dismissive of the inflation increase. They're not really taking it in too much into account. The characterization of it was bumpy. What me worry? So that's fine. But if you're holding 30 years of debt at interest rates that may not sufficiently compensate you if you are at a longer period of a 3% inflationary period, that's a bit challenging and a little bit problematic. I think for the front end of the curve, it's a little bit easier story because you have less exposure because of the maturity and roll down that you benefit from there. But I think you have to be a little bit concerned about the longer run trajectory here, both from what we heard today in terms of monetary policy, but the other side of this, which we heard a little bit this morning in terms of Treasury refunding on the fiscal side. That's a bit more of a challenging environment for back-end duration.
Hey, Jeff, I want to build on that just a little bit. Given how established the reaction function is now at the Federal Reserve, highlighted again by the chairman in this news conference, how do you think yields will respond to the longer end to incoming information, the data on Friday, an upside surprise versus, say, a downside surprise?
Yeah, we're gonna pivot right to Friday, and we'll be back and we'll talk to you guys then. But I think that will very much be more about the front end reaction, because that's gonna be about, is the Fed really getting the slowdown in the labor markets, the normalization in the labor markets that they keep talking about, but the data isn't really supportive. Non-farm payrolls not supportive, wages not supportive.
Right.
I'm a little surprised to get more pushback on ECI, their favorite measure. Everybody expected it to go down. It went up. Yes, we can dismiss it. It had special factors. It was a bit more state and local. It was a little bit more union than private, but it didn't go down as fast as the normalization would say. And there is that kind of lurking question, Mike McKee, you asked it, are you not as restrictive as you think you are? And they'll continue to believe that they are restrictive. That's kind of the fundamental belief at this point. The question is, if the data keeps pushing against that, then does the Fed have to make a bigger pivot? Today was not that day, way too soon to get there. And that's why Powell purposefully came out very dovish. But inside the statement, one questioner picked up on, there are a little bit of hints here of moving around, the removal of kind of the implicit forward guidance on the
So again, I agree. Jay Powell's dovish, but not ridiculously dovish and not ridiculously hawkish, which is why the market is relatively flat. Wednesday, 4 p.m., May 1st. Thank you, everybody, for being here. Big earnings after hours. The market is now closed. All right, we've got some earnings. So again, we're not going to listen to any call, but we're going to take a good 20 to 30 minutes to discover what companies are going to say. Etsy, that's a big one for consumers. We need to know, do people still buy stuff off the internet? The answer is probably yes. How much are they buying off Etsy? That's going to matter for the consumer. Carvana, this thing went up. This thing was at $3 in January 2023, pumped to 47. Then last earnings, we pumped from 47 to 85, basically. And then we kind of maintained those levels. So it went up 100% last earnings. We'll see what happens today. MGM, again, the state of the consumer. Zillow, state of the housing markets. I think that's going to be really interesting. Zillow doesn't make their money off homes, but they make their money off the advertising marketplace around selling a home. So there's definitely still valuable data there in terms of what's going on. Enovix, this one's a retail cult following for batteries. TJ Rogers, chairman of Enphase, started this one again. So we'll see what happens here. And then Qualcomm, semis play, they're already up 6%. Not bad. And then DoorDash, again, state of the consumer. That's going to be important. So these ones are going to be important. eBay's today as well. Are you sure? eBay's after hours? I don't think eBay's after hours. Can you confirm if eBay's? I'm pretty sure eBay's not reporting today. I could be wrong, but let me know if I'm definitely wrong on that. I don't think they're reporting today. Why was HPE down? I actually don't know why HPE is in. Maybe because Dell was down today. Yeah, they're down 3%. Melly is today. Are you sure? I'm looking at an earnings calendar right now. I don't see Melly or eBay. Hold on. Let me pull up a different earnings calendar. Am I looking at the wrong one? I'm definitely not looking at the wrong one, but maybe I'm looking at an incomplete one. Okay, Wednesday. Today's what? Today's Wednesday after hours. Yeah, I don't think Melly is today, guys, or eBay. I don't think it's today. Okay, eBay. Oh, eBay is today. All right, I guess eBay is today. I'm wrong. eBay. eBay is relatively flat after hours, nothing too crazy. So market moves right now. Qualcomm's up. Enovix is up 6%. Not bad. After hours, Enovix is up 5% now. Qualcomm is up 3%. Let's see if I can get the numbers. Let's see if I can get the numbers. Let's see if I can get the. Oh, by the way, the weed stocks, we haven't had a chance to talk about it, but the weed stocks are exploding because of this idea that Biden's going to really make it illegal and decriminalized, which should be great for tax revenue. Okay, Qualcomm, we have earnings. EPS of 244, beat expectations of 232. That's a beat by 14 cents. Did I get my math there? Yes, 12 cents. 12 cents. And then revenue, 9.4 billion versus expectations of 9.34. Again, another company that beats on EPS and revenue. Maybe the stock doesn't go to the moon, but the company beats, which is all you can ask for in a world where inflation is sticky, that companies are beating. So Qualcomm up 5% right now. Not bad. DoorDash up 1%. I think we're still waiting for the numbers. Enovix is up 6%. Let me try to get Enovix numbers. I know a lot of people are into Enovix. I've never been a super big fan of it. I know Vitaly and Carlos, my friends on Finance Junkies, they love Enovix. But it's going to take a long time, I think, for Enovix to really develop. So that one just might take some time. We did the closing bell, Sonny. We did the closing bell at 4 p.m. Okay, Enovix, they just announced they're doing a developmental agreement with a leading smartphone OEM. Enovix is working with a leading smartphone OEM. Enovix is a battery company. Raj Slurry says, we are thrilled to announce we have advanced our engagement further with one of our top customers by reaching a formal development agreement, underscoring the value and competitive advantage of our silicon batteries that can provide to the next generation of smartphones. Smartphone battery requirements are incredibly rigorous and set the standard for consumer electronics more broadly. Our goal is to provide our customers with leading edge batteries. Yeah, dude, this just doesn't get me excited. And I know I'm super uneducated when it comes to Enovix, but like smartphone batteries are not that interesting, dude. Like people are barely upgrading their smartphones already. And now, you want to get excited about battery life increasing. Like it just never appealed to me. The only reason it was appealing is because the Enphase dude is making this. And that's the only reason I'm even looking at it, right? Because it's like, okay, well, that guy took a company from like 4 cents to $300 at one point. So you got to give him credit. But outside of that, I don't know. It's never been the most interesting stock. It's never been the most interesting company to me. I mean, even like realistically, do we care that much about batteries and smartphones? Enovix is up 11% right now, so nice to see some momentum. I don't have the numbers yet on Enovix. Let me see if I can get those numbers. Enovix numbers latest. They did acquire a company last quarter that helped them beat on the revenue. No numbers yet on Enovix. No numbers. Let's see if I can go to their website, Enovix IR. Who owns Enovix in the chat? If anyone owns it, let me know. Enovix, they did like 7 million in revenue, but again, they bought a company which allowed them to do that. Okay, we have the results. So revenue of 5.3 million. That's what we got on Enovix. Then we'll go back to DoorDash. 5.3 million. And again, the only reason they have that millions is because they did an acquisition. That's the reason. So they did 21,000 last year. They did 5.3 million this year. So that 5.3 million is not because of the company, it's because of the acquisition. So one thing to remember. Malaysia factory is being built out. That's good. They've reduced cash burn. That's good. $35 million of costs will be burned. That's fine. Yeah, I mean, that's pretty much it. Commercialization, technology, and products. This OEM deal, it's not that exciting unless, we start to see some revenue from it, but it's at least setting up the foundation for the revenue to start scaling. First quarter, 5.3 million, down from 7.4 million. So their revenue declined sequentially. Not sure why. And I don't think they're profitable. Yeah, they are not profitable. They're still not profitable, which is okay. Eventually they'll get profitable. It'll take some time. Where's Dash? DoorDash got wrecked. Oh boy, oh boy, oh boy. Oh boy. eBay's down 3%. Oh my God. Etsy is down 10%. What is going on, dude? Whoa. Look at that red candle. Holy guacamole. What happened to Etsy? What happened to Etsy, guys? What the fuck's going on? And then DoorDash. Holy shit. DoorDash is down 10%. What just happened? Oh my God. Carvana is still flat. Enovix is up 30%. So if you bet on the speculative battery company, you're up 30%. If you bet on the company that delivers you your food when you're drunk, you're down 10%. There you go. Dan Nugent says, I bought $2,000 of Enovix calls as a lotto ticket. Okay, those should be up to like, what, 6,000? You might 3x those, 2x those. Goodness gracious, dude. Enovix pumping on that news around the development of a deal with a leading OEM for smartphones. Okay, let's pull up Etsy. Why is Etsy down 13%? Wow, Matt, what's going on, dude? Selling Tesla, then selling Enovix? We got to stop this, Matt. What are you doing? You sold Enovix on Monday. You thought they would dump on earnings? Now, granted, I don't know much about the company, so I guess you knew a little bit more than me and you thought they would dump, but oh man, these guys are up. Now, we'll see if the 30% holds on Enovix. Enovix has had these moves to the upside and downside plenty of times, and then it falls off, right? So, I mean, you can't just believe Enovix will hold this 25%. We'll see. MGM is flat. It's down 1%. Nothing too crazy. Okay, let's go. Let's do DoorDash first. What the hell's going on with DoorDash? DoorDash IR. What's going on? How is DoorDash? Dude, so the other day I ordered a cheesecake from DoorDash, okay? I ordered a cheesecake from DoorDash and they said, hey, do you want to give a tip? And I said, no. Okay. I said, no. You know why? Because I'm already paying $19 fucking for this DoorDash. So I'm not for the cheesecake. So I said no. And I felt so bad. Like, this is just like, I don't know, dude. I just felt so bad. I was like, this is not, yeah, you should give a tip, right? Like, no, okay, I'm not going to give a tip at Starbucks when they ask you for a 20% tip after I ask for like a latte. I'm not doing that. I'm not that crazy. But if someone's going to go drive to get me my food, like, you know, I got to give a tip. So I went in and I gave them a tip and I overpaid for a cheesecake. And still DoorDash misses on earnings, even though they're getting all that juicy revenue from me. Okay, so DoorDash earnings. Total orders increased 21% year over year. Okay, that's fine. 620 million. Revenue 2.5 billion. That's up 23% year over year. Net margin 13.1% from 12.8%, so up 300 basis points. That's not bad. Wow, these guys still aren't profitable, but they're getting close. 25 million. They're getting close. They lost 7x more than so EPS is up 700% basically over the past year, which is not bad. That's not bad. What were the expectations? So DoorDash expectations, EPS, the street wanted -4 cents and they wanted 2.45 billion in revenue. So they beat on revenue and I think they beat on EPS. Why are they down? Why are they down? Enovix up 31%. Yeah, that's great for Enovix. Why is DoorDash down 10%? Is it because they're not profitable? Is that like, that's not a interesting. Okay, we'll do Etsy in a second. Where's Carvana? Or Carvana's pumping? Dude, Carvana always fucking pumps. I don't know what makes this thing pump. It's not even profitable, this company. They're up 10%. Of course. Look at this. This thing's going to go up 30%. Dude, they pump every time on earnings. I don't get it. I don't understand. I do not think these guys are profitable. And like, the business is not that exciting. But oh, wow, Etsy's down 17%. What is going on, dude? This is not good. We don't want to see Etsy down 17%. Carvana's up 18%. Let me pull up Etsy's numbers. Let me pull up Etsy. What is happening, bro? I hope this is not a preview of Shopify. I hope this is not a preview on Shopify. Oh, really? The street's going to sell this off? The street's going to sell this off for Etsy. Carvana's pumping right now. Is the street really going to sell this off? They missed EPS by 1 cent. They missed revenue by 40 million. Really? Like, come on, dude. The guidance has to be discussed. There's no way in hell the street is selling off because of this. There's just no way. If the street's selling off because of this, then the street is like bipolar right now, because you're like to come in line with those numbers and expectations is not a reason to sell. Let me pull up the numbers. Let's see. Let's try to get some better coverage here. This is ridiculous, dude. Okay, we got some coverage on it. Let's see. It has to be the guidance. It has to be the guidance. eBay as well. Okay, so let's play this here. eBay and Etsy. Let's see what they have to say.
25 per share adjusted versus the estimates of $1.20 per share. Revenues 2.56 billion, higher than the 2.53 billion that analysts were looking for. Revenue guidance here for Q2 a bit lighter than expected, 2.49 to 2.54 billion range, and Q2 EPS also a little bit lighter than expected. The company giving a range here of $1.10 to $1.15, a little lower than the $1.14 initially estimated. And as you can see, the stock now is down by nearly 9%. And then moving on to Etsy, that stock is also lower right now. Q1 earnings here, 48 cents adjusted. That's lower than the 49 cents that analysts were looking for. And revenues right in line, 646 million for the quarter. That's exactly what analysts were looking for. But as you can see, that stock is also lower by more than 16%. Now we'll bring you any updates as we get them, guys. Back over to you.
All right. Okay, thanks. We've also got Carvana earnings. Phil LeBeau has those. Phil.
John, check out shares of Carvana. You want to see a pop? This is a pop when you beat the street by such a wide margin, and that's what we're seeing with Carvana. Earnings per share, a profit of 23 cents a share. The street was expecting a loss of 74 cents a share. Revenue better than expected by a wide margin, 3.06 billion. The street was expecting just under 2.7 billion. Not going to go into all the details, but the key ones all revolve around the vehicles sold and gross profit per vehicle. Vehicles sold up 15.9% compared to the same quarter last year, coming in at a gross profit per vehicle of $6,802. That was an increase of 41.8% compared to the first quarter of last year. How did they do it? The company tells me they were much more efficient. In fact, their days to turn was down to 13 days, one of the lowest days to turns that they have ever had in terms of their business. Their retail guidance in terms of Q2, they expect retail vehicle sales to grow sequentially from Q1 to Q2, also issuing guidance regarding adjusted EBITDA. They are expecting adjusted EBITDA growth in Q2 relative to Q1. That's the reason you see a stock up 25%, a much bigger beat than expected. Profit of 23 cents a share. Street was expecting a loss of 74 cents a share. Guys, back to you.
So it makes sense on Carvana. Again, street expectations were just so low for these guys, and they beat pretty magnificently. Wow, they're up 30%, dude. They're up 30%, and they're not stopping. Last time they went up 100%, literally. So Enovix is giving up some of their gains. They were up 35%. Now they're up 18%. Qualcomm still up 3%. DoorDash still down 10%. eBay recovering a little bit. They're down 7%. And then Etsy. I don't get the Etsy thing, dude. EPS and revenue came in line. I don't get that one. Carvana was $4. That was correct in like January of 2023. So it's what, $100? So basically what, 20x? Right? No, 25x. Incredible. Will Addison, thank you for the $2 super chat. I have $65 and $60 puts on Etsy ahead of the 5/10 expiration. So Etsy's what, right? $60 for now? Okay, so you're in the money on one of those, or on both of those actually. You might be, I mean, you could roll them and not have too much of an issue there, but I don't think the Etsy dip last. I don't think I think this, dude, I feel like this has to get bought up. Who drops the stock 14% off of these numbers? Like, I'm trying to pull up their actual numbers and see what else did they say. Like, did the CEO leave or something? Like, what did they say? Is this the results? Okay, here's the results. What did they say? Yeah, I'm trying to find the guide. Okay, so our first quarter performance, while in line with our guidance, was pressured by the challenging environment for consumer discretionary products, which continues to be a headwind. That said, we are encouraged by the meaningful progress. Blah, blah, blah. What was the bad number then? Okay, so Etsy Marketplace was $2.6 billion, down 5.3% year over year. That's bad, but that's not crazy. Revenues were in line. EPS was in line as well. Revenue 645 versus 603. That's up 0.8% year over year. So revenues grew 1%. So that's fine. Oh, they own Depop? I didn't even know they own Depop. That's one of those apps. Guidance for Q2. The year-over-year decline in consolidated Q2 2024 GMS is expected to be similar to actual Q1, with the downside being a mid to single-digit decline. Okay, so they said they might decline a little going into Q2. I still don't think that's a reason to go down 16%. That's a bit insane, dude. That's a bit insane. 16% is stupid. That's wild. Okay, where's Carvana? Carvana, wow, 34%. Let me pull up their numbers. Holy crap. Carvana. Carvana is a company that allows you to buy used cars, if I'm not wrong. Carvana. That's what buy and finance used cars online. So, well, used car prices have gone up, especially if we look at the CPI. The index for that is still higher than it's been over the past couple months. Let me pull up their numbers. Carvana news release, Carvana 2024. Okay, it's still not on their website. Shareholder letters, still not there. Very interesting, dude. Very interesting. I mean, used cars, huh? That's where the money's being made right now in the market. Used cars. Let me get it on Twitter. It's not on their website. Carvana. Oh, and Zillow. Wow, Zillow's down 8%. Whoa. Zillow's down 8%. I didn't even see that one. Okay, Carvana. I think this is why Carvana's up. They're profitable. Yeah, they made 50 million bucks in profits. That's why they're up. Carvana, there you go. They were profitable. Carvana made a profit. That's it. Record net one income, 49 million. Adjusted EBITDA, 235 million. GAAP operating income, 134 million. Revenue, 3.06 billion versus 2.69 billion. EPS, 0.23. That's all Carvana needed. That's it. That's what Carvana needed. Okay. DoorDash still down 10%. MGM is up 2%. Zillow's down 7%. And Enovix is up 22%. Carvana still up 31%. So let's go to we did DoorDash. Let's go to Zillow. What's going on with Zillow? You would imagine Zillow would be down because the housing market has not been the best, but okay, here, we got the numbers here. Oh, I like this. They put their numbers right on the website. We don't even have to click on something. Look at this. So 529 million in revenue, 217 million monthly unique users. I bet a bunch of those people are just people that are window shopping for houses they can never buy. Maybe like myself. But still, 2.3 billion visits, 646,000 employees, 4.1 million actual buyers shopped using Zillow, 160 million homes in living database. So let's put up their results. Revenue, 529 million, up 13% year over year. That's not bad. Net loss, 23 million. So they lost 23 million. Is that better year over year? Oh no, that sucks, dude. Last year, they lost 22 million. This year, they lost 23 million. That's why Zillow's down. There's no good momentum there on Zillow. That's why they're down. Q1 adjusted EBITDA, 125 million. Traffic to Zillow's group mobile app websites was 217 million in Q1. Visits during Q1 were 2.3 billion, up 3.3% year over year. Residential, 393 million. Rentals, 97 million. Mortgages, 31 million. Other, 8 million. 529 million. So they're growing, but they're not like a marketplace that's growing dramatically. Remember, Zillow had the iBuying program they had to close down a couple years ago. They tried to do what Open Door was doing, and it just didn't work. And so now they're a marketplace. CEO says Zillow's strong revenue numbers across the business helped us once again meaningfully outperform the residential real estate industry as we continue to execute on our growth strategy and expand the breadth and depth of the market coverage for the housing super app experience in 2024. We've organically amassed and maintained a large engaged audience and strong brand, and we've been investing heavily in software to digitize the entire experience. All right. I mean, not crazy. Let's get a little bit more coverage on Carvana, and then we'll keep going from there.
Here, we got rough tape in overtime on DoorDash, eBay, and Etsy. Of course, there are more details beneath the surface there, but how important is continued consumer strength, maybe even especially at the mid to lower end for continued strength in the economy from here?
You know, I think in the big picture, John, the consumer's in great shape. The consumer's delevered. If you look at consumer debt as a percentage of disposable income or GDP, it's come down. You've got great stories in the job market. Even though the JOLTS data came out a little lower, I mean, it's still way above pre-pandemic levels in terms of job openings. The unemployment situation, we all know, looks pretty good and has been amazing. People have jobs, and at the bottom end of the income distribution, that's where the wage growth has been the strongest. It's been almost 3 times what it's been at the top end. Adjusted for inflation, positive, over 3% per year since the start of the pandemic. So big real wage gains, highest marginal propensity to consume consumers. Those with the lowest income and wealth are probably the net beneficiaries here in this labor market. It's much more of weakness in the white collar jobs and the sort of the middle tier jobs and those middle quintiles. So I feel pretty good about the consumer. I feel a little bit nervous, as Jay was talking today, about how he wants to make sure demand stays in check. But, he's done a lot. It's stayed pretty much robust enough. The supply side's been working overtime for him on inflation.
Here's Zillow. Let's get an update here on Zillow. It's pulling up real quick. One sec. Let me just refresh it. All right, here is some coverage on Zillow. Here we go. Carvana is still up 30%.
Has the numbers. Hi, Dai.
Hi, Morgan. Yeah, and Zillow stock is taking a hit down around 8%, not because of the earnings on top and bottom line. That was a beat. EPS of 36 cents a share versus estimates of 32. Revenue of $529 million versus estimates of $509 million. Revenue up 13% year over year. It's the guidance that's the problem. I'll get to that in a second. Rental revenue was the real winner, up 31%, primarily multifamily. And interesting, they said they benefited from occupancy rates coming down off historically high levels, which drives an increasing need for advertising. Occupancy is down, of course, because so much new apartment supply is coming on the market this year. Traffic to Zillow Group's mobile apps and sites in Q1, it was flat year over year. There was mention of the big settlement on commissions with the realtors and brokerages in the shareholder letter. CEO Rich Barton wrote, the substance of the settlement is what we've characterized as a very reasonable mid-path forward for the industry, where commissions are negotiated and communicated between buyers and sellers, and both parties are better educated. Now, Zillow gave weaker than expected Q2 guidance, noting the recent rise in mortgage rates. Where have we heard that? And some underperformance among first-time home buyers. It did, however, reaffirm full year. Kind of questionable as to why, though, guys. Back to you.
All right, Diana Olick, thank you. The share's down 8.5% for Zillow right now. Let's turn back to the macro. The average is losing their post-Powell gains into the close. So what's ahead for the Fed? What's ahead for the markets?
We'll look at that in a second. Yeah, I mean, this is a really interesting earnings day. So DoorDash now down 14%. Goodness gracious. Etsy down basically the same 14%. Carvana's up 30%. Zillow's down 10%. And Novix are up 15%. And then Qualcomm up 4%. DoorDash's numbers were not bad, dude. They were not bad to the point where they deserve to be seeing this. I had them pulled up. I want to go through them again because we didn't get a chance to really go through them. What happened post-Powell? I think the market just sold off post-Powell because the market wanted to sell off. It was no real big reason. But Powell did what he needed to do in terms of not being overly hawkish. So this is DoorDash. I'm trying to see, what are they saying that's bad? Yeah, they're not profitable, but they're getting very close to profitability. So if they're selling them off because they're not profitable, that's just dumb. Maybe that's a real buy the dip opportunity. I just don't like DoorDash fundamentally as a business. I think Uber Eats is competitive with it. I think there's a variety of other factors that make DoorDash competitive. Are they a Grubhub, right? Are they like a pseudo monopoly in the space? Not really. Do a lot of people use them? Yes, but it's just not the most exciting business to invest in. Like DoorDash having, delivery. The future of food delivery is not that exciting. We improved logistics quality and efficiency. It drove incremental operational scale. Also, their margins are not amazing either. Their margins are they're negative right now, but their net revenue margin is up 13%. Obviously, net income is negative, but revenue increased 23%. Net revenue margin was 13.1%. $1.3 billion in costs of revenue to get the $2.5 billion they brought out. And then GAAP sales and marketing was $5 billion. Damn, they spent $500 million on sales and marketing, dude. That's a lot. That's a lot for sales and marketing. And I do see a lot of their ads, so they definitely spend. R&D was $300 million. Why are you spending $300 million for a food delivery app for R&D? What potential R&D is really worth $300 million bucks, dude? That's interesting. $300 million. What are they going to build a fucking food LLM or something? Like, what are these guys doing that needs that much R&D? $279 million for R&D. It's a food delivery app, dude. Like DoorDash, Uber Eats, Grubhub. I go through all three of them. They're relatively the same. There's nothing that different. If anything, the DoorDash fees are just insane. $279 million. It's all about AI. There's no way they spent $300 million just to do more AI developments. Like also what I understand DoorDash's use case of AI is ranking algorithms and recommendation algorithms to be able to get you to ultimately buy something. That can't be, I mean, they've had those algorithms for years. Maybe they're getting more sophisticated, but 300 million in 90 days? Like what the hell are you guys doing there? Enovix up 15%. Carvana's up 30%. Carvana not giving up. eBay. Oh, let's go to eBay numbers. We haven't looked at eBay numbers. eBay IR. Let's look at eBay. By the way, has anyone ever bought or sold something on eBay? I have never bought or sold something on eBay, interestingly enough. I think maybe once. It's been a long time. DoorDash wants FSD. Dude, how are you spending $300 million on R&D? What possible R&D is DoorDash doing? Okay, revenue of $2.6 billion for eBay, up 2%. Wow, they are not growing. GMV of $18.6 billion, up 1%. Wow, they are not growing. GAAP EPS of 85 cents. They bought back $500 million of stock and they paid out $140 million in dividends. They made $439 million in profits. Yeah, what's the, you know what's funny about this? Steve called me about eBay 3 weeks ago. I'm just remembering, and he said we need to look into eBay. And I forgot his reasoning, but he said some reason to look into eBay. And my response to him was, dude, no one uses eBay. Now, I'm wrong on that. People definitely use eBay. Yeah, I don't use it, but people definitely use it. But the problem is people also use Amazon a lot. And I don't know why anyone would buy something off eBay if you could buy the same thing on Amazon, because you get it in 2 days and you don't have to worry about some buyer ship. Now, if you're getting like an exclusive like Pokemon card or something, yeah, you're probably going to find it on eBay. But outside of that, I don't know how many people love eBay. I mean, let's go to eBay's website. I don't think I've been to eBay's website in years. eBay.com. Yeah, dude, I'm not buying stuff from eBay. I don't know if it's just me. I really never bought on eBay. Like water bottle. Let me show this water bottle. Yeah, look at this, dude. Like I feel like this water bottle you get on Amazon, like it's just such a different experience for me. I don't use it. Let me know if people use it, but I wouldn't use it. Now, if I needed an iPhone, maybe I'd use eBay because Amazon might have more expensive iPhones, but outside of that, I don't know. I don't use eBay. Regardless, eBay is down. So they didn't miss on their numbers, but they're just not growing anymore. Enovix is up 15%. I'll be curious to see if that actually sustains itself. I mean, Enovix, again, it's very speculative. It's $1 billion company doing $5 million in revenue, dude. And that 95% of that $5 million came from an acquisition. It's not even from them. So remember, if you're buying Enovix and you're like, oh my God, it's up so much, it's $1 billion company doing $20 million in revenue, with the potential that their batteries are going to be like powering the next generation of iPhones. By the way, if Vision Pro doesn't work, that's bearish for Enovix, because one of the bull theses for Enovix was that Vision Pro was going to need batteries that are not attached to your hip, and Enovix was going to build them. But I don't know if Vision Pro is going to work out necessarily. Dominic says I sell all the time on eBay. Wow, I've really never sold on eBay. It's for used stuff too. Yeah, people buy used things as well. Just got here. Did you go over Etsy? Yes, Etsy's down for no reason, in my opinion. Etsy's down 13%. Some of their guidance is weak. That's fine. But EPS and revenue came in line. EPS, they missed by 1 cent, 48 cents versus 49 cents. I don't think they deserve to be down this much. Carvana's up 35%, dude. Carvana's pumping. Carvana's pumping. Carvana's a different level of a pump. Different level of pump right now. Wow. Incredible. Incredible stuff, man. Incredible stuff. Michael Davis says their mapping tech is like 5 years out of date. Their drivers can't find my house that was built last year. Okay, so my question then is, do you think they need to spend hundreds of millions? I mean, we're talking about basically $3 million a day they've spent on R&D. Does it cost that much to build out new mapping architecture for DoorDash? I mean, maybe it does. Maybe I'm wrong here. Maybe it does, but it's a lot of money on R&D. And it's not like there's, if they could accelerate AI to make the recommendation algorithm so good on DoorDash that you know exactly what you want to eat as soon as you get on it, then yes, I could see that driving incremental growth. But the problem is when people go to DoorDash, or at least when I go to DoorDash, I kind of have a feeling of what I want to eat. I don't go to look and browse. I know, I want Cheesecake Factory. DoorDash is just a tool for me to get it. Just like Uber or Lyft. I got to get to the airport. Whichever one's cheaper, I'm going to use it. But maybe their data suggests that a lot of people are using the platform in a search and discovery type of manner. And as a result of that, they need to do some R&D to be able to help the conversion on that search and discovery actually result in a sale. Josh says if DoorDash's AI is that good, they should become an AI company and dump their core business. Armando says that's you, bro. I gotta browse. All right. I mean, I don't use DoorDash or Uber Eats that much, so when I want something, I know what I want, right? I guess the far majority of people do use it as browsing versus just buying. Why don't you use Uber Eats? Usually it's cheaper for me. Oh, so Uber Eats I usually do, but they didn't have Cheesecake Factory, and I had a random craving for cheesecake last week, and I had to use DoorDash, right? So like that's where I saw the use case, but I couldn't imagine investing in a stock like DoorDash off the bet that people will use your product if they can't use Uber Eats to get their stupid cheesecake craving, you know? But maybe I don't understand the story as well, dude. Fun fact, the CEO of DoorDash is on the board of Meta. The CEO of DoorDash is on the board of Meta, which also, it also was very interesting to me that that guy is that special to Meta. Is he still there? Yeah, right here. Look at this guy, Tony Zhu. I had more respect for DoorDash after I found that out because I was like, damn, Zucks really wants him on the board. Mr. Zhu is the chief executive and co-founder of DoorDash, a leading technology company. This is weird, right? How many people knew that? How many people knew the chairman or the CEO of DoorDash is on the board of Meta? We know where they're spending their ad dollars, bro. Those ad dollars are going to Facebook Incorporated. So, DoorDash, definitely incredible business, incredible founder. Just always was curious why there's such a substantial moat there. Carvana's up 35%. Yeah, it's up. All right, guys. I think that's it for me. This is incredible earnings season we're having so far. MGM's up 1%. Carvana's up 35%. Again, they beat and they're profitable. Carvana's profitable for those that are wondering why. $49 million. Street's excited. Etsy's down 13%. Enovix is up 15%. Qualcomm up 4%. DoorDash down 12%. Zillow down 10% now. And then eBay down 5% on the day. And we'll see how things turn out. Last look at the markets. Let's look at the markets. Tesla, wow, below 180. Tesla's down. Bitcoin 57.3, down from 59. PayPal is green a little bit after hours. SoFi down 691. Snapchat, wow, Snapchat's up 5% today. Huh? Snapchat 1589. S&P is at $500. It's flat after hours, but the Jerome Powell pump is erased. Meta's down a little bit, and then Palantir is at 22.13. Palantir maintaining a little bit of the pump. It was at 22.60, now down at 22. And then Robinhood, wow, got demolished. Robinhood was at 17.30, now it's at 16.65. The pump was just not good enough to last. Palantir 22.12. Jerome Powell pump just not good enough to last. Wild day when it comes to earnings. Market open tomorrow. We'll discuss a lot more about what Jerome Powell said. Again, he was not hawkish. He was dovish, not overly dovish, which is why the street probably sold off. Palantir Daily, I'll have my Q1 expectations come out in just an hour for what's going on with Palantir. So you guys will get my thoughts on there. And then tomorrow, we'll see if this market can hold up and earnings season can continue. Today's Wednesday. Tomorrow, we have Apple. That's going to be a big day tomorrow on the market close. We'll see what Apple has to say. Keep going from there. All right. Thank you, everybody, for joining. I appreciate it. I'll see you guys tomorrow on the market open, 8:45 a.m. And thank you all for joining if you were here when Jerome Powell was talking or if you came on the market close. Bye, everyone. Have a good one. See you guys tomorrow in the morning. Good night.